Thanks for being here. Thank you very much, Ethan. Just to kind of level set on everything, I think everyone is probably familiar with the Plaid liabilities platform, but Charlie, if you would just to make sure, just kind of tell everybody about the platform, the various liabilities that you're serving now, we can then, go from there.
Yeah. So the way I describe Plaid at a high level, we built a platform that enables applications to be able to connect into financial institutions and be able to pull data from those financial institutions. So early days, we started off with banking data, so being able to pull down payment data, transaction data. We soon kind of updated and expanded out to identity data. And then most recently, we launched being able to pull brokerage data as well as also liabilities data. For us, liabilities meaning debt products. So the first debt product we were able to integrate into was student debt, which I think Mike can speak a lot to. And also recently launched being able to pull credit card debt.
Public data? Paid or public private data?
So it's not payment, it's all, so the key, it's consumer permissioned. So if you've ever, like the example I typically give, if you ever use Venmo for a chance, there's some flow. At some point during the onboarding process, we were asked to link up your external bank account to Venmo. At some point, you probably selected your bank, logged into your bank account, and permissioned Venmo to pull data from your bank account. That entire experience is powered by Plaid. So it's consumer permissioned. On one side, we built out thousands of integrations to a ton of different financial institutions. On the other side, we have an API that applications integrate into their applications to be able to pull data on behalf of the consumer.
And so have you talked about where you might be going next after credit card data?
Yeah, I think more broadly, a lot of it's actually kind of driven from our clients and our customers. So I think like the liabilities endpoint was actually something that we spent a lot of time working with the Pillar team on understanding like what are the needs for their end users and their end consumers that they're trying to solve. What are the pain points? What type of data points would be useful? And that's how we actually go and prioritize the type of data, the type of institutions we go and build out integrations to.
Got it. So no, but in terms of where you're going next, you haven't been public as to which liabilities yet. I mean,
nothing yet. Yeah, okay. I would say like I think like further debt instruments probably gonna be interesting, but I think nothing public yet.
Nothing public yet.
Yeah.
Okay. So if I said autos or mortgages, you would say no comment.
Potentially.
Potentially
yes,
no
they're
comment.
All very
okay.
interesting.
They're very interesting. Okay.
Yeah.
All right. Let me hand it over to you, Michael. What does Pillar do besides trade stocks?
Besides trading stocks, yeah. I guess we have two companies I've been running
exactly.
without knowing it. So Pillar, we're a personal finance startup that helps people manage and get out of student loan debt faster. So we hook up to people's bank accounts and to their student loan providers, thanks to Plaid, and we look at their income, their spending, their loan information, and use all of that to figure out what is the fastest and best way for somebody to actually pay off their student loans faster than they are today.
By show of hands, how many people here have student loan debt? Are people not raising their hand because they don't want to say, in your opinion?
It depends on the group, but that seems like a decent showing. It looks like about a third of you. Yeah. Across the board, so there's 45 million people in the US that have student loans. 7 out of every 10 people that graduate from college need it in order to be able to pay for it. So maybe not in New York City where things are very expensive already, but elsewhere it's just a massive problem that people have.
I bet almost everyone
Maybe that was the better question.
Yeah, exactly. And what is the founder story? Like, why student debt? Why now? Why you?
Yeah, so before I founded Pillar, I was at DoorDash, the food delivery company, for a few years where I ran the California and the New York regions. It was an amazing few years there, but after 3 years, I decided to go to business school over at Stanford and did that right at the same time when my wife, who is sitting right there, was graduating from law school with $300,000 worth of student loans. And so, we really struggled to figure out, with me about to take on another $250,000 worth of loans with that $300K to begin with, how we were actually going to make that happen. And when I started doing research and looking into the space, I realized that there's millions of other Americans that are struggling with this as well. And so decided to drop out of business school to do something about it.
Okay, so first an obvious question would be, what law school did you go to? And so 300 sounds like it's above the average, or maybe I'm wrong, but where does it?
Completely what everyone probably
Gotcha. That's quite a thing. That is quite a thing. Okay, so you had this debt. You dropped out of Stanford in part because you didn't want to be looking at 560,000?
560K, yeah.
Right, so you were like, fuck that, I'm going to go and get a proper job and all that kind of stuff.
Proper job with no salary.
Proper job with no salary, exactly. Although DoorDash, given the amount of debt that it just reported, it's nice. All right, so talk about the relationship with Plaid here, and if you would even have been able to build your platform were it not for the fact that Plaid launched the liabilities platform.
Yeah, so we actually had quite a journey getting to where we are today from about a year and a half ago. Before Plaid liabilities existed, we were trying to build our own version of Plaid for student loans, which we literally called Pludent, Plaid for students, where we were building our own scrapers to all these student loan servicers and not doing it super well. We eventually came across Quovo, who was doing it a lot better than we were, and then about 2 months later, Quovo got acquired by Plaid. And so that's what turned into Plaid liabilities and us helping build that product from the ground up.
So in terms of so you would be able to connect with the servicers. What about the credit bureaus? And could they have figured into your plans at all?
So we don't do stuff with credit bureaus right now, but we use Plaid as well for all the banking information. And honestly, I don't think we could do what we do now without just all the integrations that they actually have.
Right, and so, correct me if I'm wrong, but I couldn't find when I was sort of looking into this, do you even have a direct competitor offering anything similar to the liabilities platform?
Actually, from a liability standpoint, I'm actually not sure. I think there are different kind of competitors in different spaces that do kind of different versions of what we do, but I think in terms of like the breadth and the amount of products and the amount of financial institutions that we currently cover, probably nothing that comes close, I think.
Gotcha. Okay, so you have this recommendation engine, right? And your focus is on student loans, but of course everybody knows that credit cards are the other big, massive, ornery expense that many people have that are also dealing with student loans. What do you do about credit card debt, right? Because if someone has $30,000 of student loans that they're paying 9% on, they're mostly Title IX loans, and someone also has $20,000 of credit card debt with a 20% APR, might it be the case that it makes more sense to pay off the credit cards rather than the student loans?
Yeah, absolutely. So we care very much about doing what's in the user's best interest. And ultimately, if there's credit card debt at a 20% APR, you should be paying that off first before you worry about your student loans. And so we take all of that into account, run it through the recommendation engine, and then figure out how much do we actually think you should be dedicating towards that source, given monthly payments that you're required to make, everything like that.
I see. So you are trying, to the extent you can, take in credit card debt, part of the equation, and and obviously you're not thinking about rewards or anything like that, but you are mindful of the fact that interest rates on credit cards can be much, much higher.
Yeah, we recognize that student loans are not the only financial obligation that people have in their lives, and so we do our best to take into account as much information as people are willing to give us so that we could make the best recommendations and do that hard work on people's behalves.
And what's your sense of, how much credit card debt is really masked student debt for a lot of your users?
In terms of how many people are paying off student loans with credit cards?
Well, no, in terms of you go to grad school and you are maxed out on your student loans, and so you start living your life with plastic, and so technically that gets lumped into the credit card category, but in reality it's education related.
I guess I need to come back and find some numbers for that
Okay.
next time.
Good. Good. And you went live when?
So we launched in June earlier this year.
Okay. And how many users do you have?
So we aren't publicly talking about users, but
Okay.
we're managing over $250 million worth of student loans at this point.
And what is your catchy little term for that?
We call it debt under management, or DUM.
Did you coin that?
I should.
You absolutely should. Okay, so Matt, but it's safe to say that things are going as expected, better than expected, or where are you in your journey in that respect?
So for us, since we launched, things have been moving pretty fast. Our team is now 15 people. We're focused on growing our user base and really, adding as much value as we can to those users.
And in looking on your site, I think it was your site, maybe it wasn't, but I learned about the difference between the avalanche method and the snowball method of paying back your student loans. So can you explain what those two are and why you've chosen the avalanche method?
Yeah, are people here familiar with those terms?
No, tell it.
All right, so There's two ways of paying back debt. This was popularized by Dave Ramsey, where the avalanche method is when you start with the highest interest rate debt and you pay that off first, since mathematically that's going to give you the least amount of debt possible. The other side is called the snowball method, where you pay off the debt that has the smallest balance, and as a result, you psychologically feel like you're making progress on your debt, and so you build up towards those really large debt balances by paying off the small ones first.
And so, from a behavioral finance perspective, you could probably nonetheless make the case that if you pay off one student loan debt complete, the adrenaline high that you get from that would further reinforce your desire to pay the loans back. But ultimately, you have concluded, at least for now, that just attacking the amount of debt is the most important thing.
Yeah, I think taking a step back a little, I think if you step forward, if you fast forward 10 years, it's going to be crazy that anybody ever had to learn personal finance concepts on their own to begin with. It'd be like if your car breaks down, like you trying to fix it yourself instead of just taking it to a mechanic who actually knows what they're doing. I think with apps like Pillar and other apps that are out there, it's going to move to a concept of automated finance where people will trust the technology that they're using to make the best financial decisions on their behalf instead of them having to do it themselves. And so because our goal is to help people get out of debt as fast as they possibly can, we will take the avalanche method, we'll pay off that highest interest rate loans first, because that is what's actually best for you, regardless of what you might want to do.
So when is this automated finance, self-driving finance future going to actually be here en masse, Charlie?
That's a good question. I don't know. I don't know, but I do believe that is the world that we're moving towards. I think there's still a lot of problems to be solved, and that's what we're doing on the platform, on the infrastructure layer, to be able to support that, right? I think in order to be able to truly have something that's real time, you need access to real time data. So that's something we actually spend a lot of time with regulators, with banking partners, with financial institutions on helping them understand the value of that data and the value of opening up access to that data.
Can you guys hear us in the back?
Yeah, it's okay.
Cool.
Okay.
A little bit?
I can speak a little bit louder. So I think it's gonna take some time, and I think there's a lot of interesting problems still remaining to be solved within the infrastructure layer before that happens. But I think that is starting to accelerate.
So what is like the biggest problem you see from an infrastructure perspective?
Yeah, I mean, I think most of the United States financial infrastructure is completely outdated, right? Like the fact that you can order something on Amazon and get diapers delivered in a day, but you send an ACH transaction from one bank account to another, and it takes 3 to 5, right? That's completely digital. It's not physical goods. It's not something physical being transported over, but it takes a long time because of just the way that our financial infrastructure has been set up. So I think there's a lot of interesting companies in that space that are trying to tackle that problem. But until I think we solve those like underlying problems, like it doesn't matter if I can't move your money instantly, you're not going to be able to necessarily trust something in real time. I think today.
And so how does CCPA and some sort of national data privacy law, if it ever occurs, how does that sort of play into this idea of automated finance?
So I think it's a little bit tangential. I think the thing that's interesting around things like GDPR, CCPA, particularly around financial services, is that most companies, pretty much every company in financial services, is used to this, right? Like we're used to being regulated. We have compliance teams, so I actually don't think it's going to have a really huge impact on cross financial services. It's just something that we're going to make sure to stay abreast of and stay aware of. And I think there's some interesting threads around helping consumers be aware of what type of data they're sharing, and we very much are aligned with that perspective. But I think from the implementation perspective, there's not going to be a whole lot of changes necessarily for financial institutions. I actually think that for other tech companies or for other retail companies that don't necessarily have compliance teams, that don't necessarily understand regulatory positions, it might be tougher for them. But I don't think it's going to have necessarily a huge impact across financial services. That's something that I think we're all used to.
And so, but you obviously, Plaid is a big company, has a lot of resources. You on the other end of the spectrum, if a national data privacy law came down the pike, would that be very, very difficult for you to swallow because you'd be like, oh my God, I have to go out and raise a shit ton of money tomorrow to pay for all this?
I think for us, personally as a company, we've instilled best practices from day one and knowing that this stuff was down the pipeline for us. And so by building it up at the beginning, it actually reduces those costs significantly later on. And so I think it really just is about being mindful and thoughtful and weighing those pros and cons appropriately to see what the best course of action is.
Okay, I'm going to ask you another question to try to get you to say, yes, we'd raise a shit ton of money if this happened. So let me ask you, in thinking about large financial institutions that want to remain relevant, that want to connect with younger users, do you entertain the possibility that, Marcus or some other big financial institution will say, these guys over at Pillar are doing something really cool, let's do that too, and utilize our user base and our marketing power and our brand to, blow these guys out?
I think Credit Karma came out in 2007 or 2008, I want to say. Robinhood came out in 2013. And so it took about 10 years before all the banks started offering free credit scores, and 6 or 7 years until Charles Schwab and TD came down on the fees to execute those trades. I think big financial institutions take a very long time to do stuff, and the distribution that they have is obviously incredible, but there's still a lot of room for startups to be able to build a wedge and build a solid foundation for themselves to work off of.
Can you ever envision doing a partnership with a major financial institution?
I think it could be in the works.
Could be in the works, okay. Trying to break some news. All right, well, I want to talk about the PFM space, which is your space, and we've talked about this, earlier. I totally get it, the idea of optimizing for credit, the idea of having a great budgeting tool that is powered by sophisticated machine learning is great. Being told you can't afford the triple frappuccino and instead you should use it to pay down debt is great. But I can't help but think that seeing some of the valuations, I won't mention any companies in particular, but seeing some of the valuations associated with PFMs that essentially are doing budgeting kind of feels like maybe things have gotten ahead of themselves a little bit. And I recognize you have a lot of clients in that space, but I want you to just tell me I'm right or tell me I'm wrong, but tell me something on that.
Interesting. I'm actually curious, what are the PFMs that are overvalued? If anything, I actually think that the PFM space, from an investor perspective, tends to be overlooked. I feel as though most VCs think Mint.com as the ultimate exit. I think they exited for like $250, $300 million, and that's sort of like the cap of an exit for PFM. I don't know if I necessarily agree with that.
There's a lot of blurring of the lines as well.
Right. Yeah, I think that what you see with a lot of applications initially start off as like a PFM because it's a lot easier to get off the ground. You're read only. You don't necessarily have to build out that big compliance team because you're not sending payments, so you don't have write access to that bank account. Right. The moment you start to enable write access to that bank account, that's when you need to have SOC 2, PCI, all these fun acronyms and compliance things put into place, and that's expensive. But I think we have seen a lot of interesting companies not necessarily pivot, but expand out their product suites to move from great. We can pull in the data, we can offer you those insights, but we want to move towards a model where instead of offering those insights and assuming you're going to action upon it, can we do that action for you, right? So I think you're starting to see the beginning stages of autonomous finances. I don't think anyone necessarily does it perfectly quite yet due to a lot of the infrastructure that we talked about before, but I think we're early days of that movement.
What do you think?
In terms of valuations in
I just
particular?
want you to comment in general on the idea that there are a lot of PFMs out there. There's a blurring of the line between PFM and Robo and some of the other services that are provided on top of that, lending. But it is a very, very big space, and defensibility is really important. And you're seeing a fair bit of rebundling among some of the larger fintech platforms to try and keep their hooks in. But there is also a realization that acquiring customers is really expensive. And you're on the early stages of your journey. But this is my nice way of asking you, what is the keep you up at night type of issue that you have?
It's a good question. I think for us, as we think about the future, I guess, and we have an investor here in the audience, so I hope we're not one of those overvalued companies. But I think it really does go down to just building an amazing user experience. And like I talked about Robinhood earlier, where they've been able to build all these, Robinhood in the investing side, Lemonade on the insurance side, which we could call a fintech in this case, by building these really amazing brands and user experiences, I think you actually are able to have defensibility and justify these very high prices that people are paying.
And just to be clear, you right now are not charging for the service, right?
We're not right now, no.
Gotcha. And have you made a decision when you start to charge how you're going to charge?
So we'll be charging a monthly subscription fee in return for all that automation that we provide.
Got it. So you're not going to be charging on dumb.
No.
Gotcha. Okay. Ethan, thank you very much. This has been great.